In 2024, the world is grappling with a relentless economic force, which is global inflation. Rising costs of goods and services are squeezing pockets everywhere, from the wealthiest nations to the most vulnerable. But as central banks scramble to keep inflation in check, one question looms large. Are they losing control? Today, we'll dive deep into the global inflation crisis, explore what central banks are doing to combat it, and analyze whether their efforts might be too little and too late. So stay tuned, because what happens next could affect us all. Inflation, the rise in prices over time, is a normal part of any economy. But in recent years, it's been anything but normal. After the COVID-19 pandemic, inflation rates soared to levels not seen in decades. For instance, United States experienced inflation rates peaking at over 9% in mid-2022, highest in 40 years. European Union faced similar challenges, with inflation exceeding 10% in several member states. Globally, inflation has become a common story, from Argentina to Turkey, where inflation has skyrocketed. As of July 2024, inflation in Argentina is at 263%. Turkey has also been badly impacted. Where prices are rising at an alarming rate, the situation is dire. In July 2024, the inflation rate in Turkey is hovering at around 62%. Even in countries like Japan, where inflation has historically been low, prices are creeping up. But what's driving this global surge in inflation? Several factors have converged to create the perfect storm. First, the COVID-19 pandemic disrupted global supply chains, leading to shortages and higher production costs. When demand returned, supply couldn't keep up, driving prices higher. A report has been published by the World Economic Forum as to how COVID-19 has impacted the supply chain. The report has clearly mentioned that most of the CEOs of big companies has identified the supply chain disruptions as the greatest threat. Next, the war in Ukraine further complicated the picture. The conflict caused energy prices to spike, particularly in Europe, where gas prices more than doubled in 2022. For example, crude oil was $92.77 per barrel on the 24th of February 2022. But rose and averaged $106.96 from the 28th of February to the 3rd of August. Food prices also shot up, with wheat and corn exports from Ukraine plummeting. Finally, central banks themselves played a role. During the pandemic, many central banks flooded the economy with money, lowering interest rates to near zero. While this helped economies recover, it also led to an overheated market, contributing to inflation. In response to the inflation surge, central banks worldwide have taken drastic measures. The most common tool, raising interest rates. US Federal Reserve, for example, has hiked rates multiple times since 2022, bringing them to the highest level since 2008. In early 2022, the federal funds effective rate was around 0.33%. But as on August this year, the rate is around 5.3%. The European Central Bank and the Bank of England have followed suit, with similar aggressive rate increases. Since July 2022, the European Central Bank has significantly increased its interest rates, with the key deposit facility rate reaching a peak of 4% in September 2023, following a series of consecutive rate hikes to combat high inflation. As of June 2024, the deposit facility rate stands at 3.75%. Higher interest rates are designed to cool down the economy by making borrowing more expensive. This reduces consumer spending and business investments, which in theory should lower inflation. But there's a catch. While raising interest rates can curb inflation, it also risks pushing economies into recession. We're already seeing signs of economic slowdown. The US GDP growth has slowed and Europe is on the brink of recession. Unemployment rates, which had been low, are starting to rise again as businesses struggle with higher borrowing costs. Moreover, there's the risk of stagflation, which is a scenario where inflation remains high even as economic growth stalls. This is every central banker's nightmare, as it severely limits policy options. The last time the world experienced stagflation was in the 1970s, and it took years to recover. So, are central banks losing control? It's a complex situation. On one hand, their actions have likely prevented even worse inflation. On the other hand, the global economy is on shaky ground, and the path forward is uncertain. What's clear is that we're in uncharted territory. Central banks must carefully balance their policies to avoid deep recessions while still taming inflation. It's a tightrope walk that will shape the global economy for years to come. Thank you for watching. If you found this analysis insightful, please like, share, and subscribe for more deep dives into global economic trends. Stay informed, stay prepared.